Hello everyone and welcome to the Macro Cafe episode 26. I am recording this on a Saturday morning. I hope you guys are having a great weekend. I am your host, the Cowboy. This is Elliott Wave Cafe. Let's get started. All right, we have lots to talk about today, just like we do every single week towards the end of the week. And we're going to cover the core markets. We're going to take a look at the US equities and see what's happening in terms of relative strength in there. We're going to take a look at the Fed and where they are on interest rates, a little bit of touch on the yield curve and the yields because they've been continuing to rally in here. Then we're going to take a look and what's going on the weekly time frames on these kind of macro charts. We're going to see who's stronger. We're going to take a look at breadth and sentiment. And then we're going to jump onto some Elliott Wave charts where we're going to study a little bit the S&P 500, ARKK. We're going to re-look at this. We're going to take a look at GBTC. This is the Grayscale Bitcoin ETF. We're going to look at the dollar, and then we're going to finish up with taking a look at Spotify, which has a very interesting chart. All right, let's get going, guys. You can find me on Twitter at Elliott Cafe in here. Please subscribe and follow me on here. Interesting commentaries in here from everybody. I try to follow a few people. I listen to what's happening on social media. I try to post a few charts here and there and my comments on the markets, hopefully on a daily basis. So go ahead and subscribe here. Also, you can find me on Telegram on my private trading channel. This is the Pro Room. Right here is the link. We cover macro assets, Bitcoin, and altcoins on a regular basis. All right, let me get out of here and let's go with, I'm going to start with taking a look at some social media charts in here because I think there's a few interesting things that we have to watch. I mean, these markets have been a complete disaster since the beginning of the year. It's been one of the worst years in the stock market history in terms of declines, but not because you've had, let's say, 20 to 25, maybe to 30% decline in equities, depending on what you're looking at, but also on the bond market. The bond market is the largest market in the world, and this one has been taking a pretty heavy beating. So I'm going to take you to some charts I've seen on Twitter. I mean, everybody knows maybe Jim Bianco from Bianco Research. He's really active on Twitter as well. Raul Pal also, it's a big macro thinker. He's got a lot of charts and things that are interesting out in there. So I'm just kind of following along and see what they're saying as well. And here is a pretty interesting chart that shows what's the year-to-date return from the Bloomberg Global Aggregate Index. So they're looking at the number of bonds that are in this index are about 28,000 plus, and the performance. I mean, this thing lost. The market value right now it's about 55 trillion, and it was 69 or something like that. I mean, it says it on here from 69 to 55. This equates to a market value loss of about $14 trillion. So it's a staggering down 21% year to date. It made another low on Friday. The S&P is down 23% on a total return basis. So, this might not feel like it's the worst time in the S&P 500, but I think it's one of the worst time in the market history because you had collapse in pretty much all the macro assets that are out there, right? There is really no safe place to be other than cash. And this chart here proves that and shows that. It's not like we don't know it, right? I'm stating the obvious, but, it's nice to kind of come back and look and put things into perspective here by looking at the bond market. We're hearing commentaries from the likes of Lynn Alden and some others, that are saying that the Fed is really playing with the fire here by raising interest rates, by doing quantitative easing on a slower global economy, and things could really get really messy really fast. So I think we are at the break or make moment in here. The markets are sitting at some very important levels. You can notice this across the spectrum. You can look at the cryptos as well, and I think some important decisions here will be made fairly soon in kind of what the market directions will be, and if we're going to break lower, if we start to rally from these levels, because the sentiment and the breadth are showing some interesting divergences in there, but I'm not sure how much to trust all of that. So here is another look at the government bonds, right? This is the fourth worst year after 1721, 1865, and 1920. Look at the massive losses that the bond market has been taking so far. I mean, it's just amazing to see. There's just a few instances in the past when the bonds have been behaving the way have been so far this year. I mean, with the yields rising, I mean, just on the, and I'll show you, I mean, just on the 2-year, you're up at about 4.5%, right? The cost of money, it's quite outrageous. Some people say that's not even high, right? But we're noticing a big flow of money and cash out of banks into more of higher yielding like certificate of deposits, and banks are losing reserves, stuff like that. So things are definitely getting interesting. Here is again just a basic 60-40 portfolio. It's an annual, I mean, the worst year to date return in the past 100 years, right? So if you think you're going to be safe in bonds, and you're going to have a mixture of, depending on your age, right? But if you're 60% allocated to stocks and 40% to bonds, this 40% is supposed to balance out your portfolio. And this is what happened, right? There's really, there's really no escape from the carnage that's been happening so far, across markets. So, really extreme levels in here. I think, definitely something has to give. And I mean, look at Cathie Wood, and I follow Edward Harrison. He's a great guy. I saw him on Real Vision a couple of years back. He used to present there, so he's got really interesting information. And this is maybe just kind of well known so far, but I mean, look at this Cathie Wood ARKK ETF, which was the proxy for extreme risk, right, for high beta stocks and assets, closes at 5-year low in about almost an 80% drop from the record high. Right, so obviously her stocks are not doing that well, and a lot of them seem to be in the final stages of their declines in here, and that's kind of how I'm looking at this news as well, that people keep piling on and keep repeating this stuff, and I mean, the losses obviously have already happened, and I think we're probably in the final stages of these declines. And then one more thing in here, if you want to see the 30-year fixed rate in the United States, it's about 7.10%, right? I mean, I have a couple of mortgages, but they're down in the 2s, in the 3s, I don't know what happens when some of these adjustable rate mortgages in the United States starts to hit these rates. There's probably going to be a lot of hurt out there in the real estate market as well. So I think maybe this is what the Fed wants, right? They wanted to kind of destroy this demand and try to tame down inflation. But I think, and I'm going to close with this on the subject, I think the story now, it becomes much bigger than inflation. Inflation, I think it's topping out. It's showing into the data that we're, kind of stabilizing around 8% at the moment. And a lot of these commodity indicators have been coming down, and a lot of this data, from example, from the housing market is lagging. But I think the story, it's moving more towards growth right now, and towards the fears of recession, the fears of Fed breaking something, and the markets are looking past this inflation data. This is just an excuse to sell, but I think there's like probably bigger issues underneath the surface that the market is facing right now, and it kind of all started with the inflation and the interest rates. But I think, when you start to scratch the surface, and maybe a market that's vulnerable and a monetary system that's vulnerable, you can find all kind of cracks, and once you start bleeding, I think it's going to be very hard to stop. So, we'll try to stay optimistic. I mean, so far I don't sound like something like that, but it is kind of what's the reality in the market at the moment, right? I'm going to show you a little bit of the sentiment indicators too, just to kind of present, let's say, a little bit more on the optimistic side of a possible rally coming out here towards the end of the year. So let's take a look at the core markets, and I'm just kind of putting them all in order of the descending RSI from strongest to the upper left to the weakest on the lower right, and you can see the dollar remains the strongest asset out there, right? This is holding cash apparently is the best thing right now, if you have any. We'll see how soon that's gonna lose status, right? But it's the RSI is declining a little bit. I mean, it's hit a pretty important high of about 80. If you're looking maybe up into this corner right there, And you know, we made a little bit of a lower high in here. The RSI is also declining. I'm still thinking, and I'll show you a count towards the end, I'm still thinking that the dollar is probably in its latest stages of this rally. The energy markets are you know, kind of correcting in here. DBE, they're still outperforming, you know, quite a lot, the other assets. But I think they're still in some kind of a correction, and they're probably going to take a leg lower as well. Commodities, also you're looking at oil that's been selling off, rallying here for the past couple of weeks back into 90, being rejected. Some important moving averages in here, and I think it's probably going to continue to, you know, go lower on the oil. I mean, if we're thinking, you know, slower economic growth and recession, I don't see how oil can really spike that much, but some people will argue differently. Copper is next here, stabilizing near the lows. Maybe, I mean, this is the Dr. Copper, right? This is the one that, and it takes a look at, you know, what's going to go, what's the health of you know, the economy around the globe, and it's you know, pretty tame right here. I'll take a look at the charts shortly. Bitcoin, it's also just sitting still at $20,000, not knowing what to do in here, right? I'm surprised it hasn't broken down already. Agriculture, it's you know, still I mean, it came down a lot. I mean, this comes out of the inflation. And then on the last place here, you have the bonds, the 20-year bonds, right, continuing to sell off. 10-year yields moving higher. You have the NASDAQ, which is the one that's been hit the worst in here, triple Qs. This is the NASDAQ 100, again, making a new low. Gold is not doing well, SPYs, and, you know, also international markets. So this is a picture that shows you that there's, you know, other than dollar and energy, you know, there's not a lot of places where you can actually be. But let's take a look. Let's see what's going on in the equities in here. You're taking a look at the Dow Jones. You know, surprisingly, or maybe not that much, but Dow Jones, it is, you know, outperforming a lot of these other markets, in terms of U.S. equities, maybe because it's got more value, a little bit more energy, a little bit more financials, you know, just companies that are a little bit stronger. You know, the companies that are very sensitive to interest rate hikes that are in the NASDAQ and maybe in the S&P 500 are taking a big beating. So being in Dow Jones, it's a little bit better. You know, you're bleeding, but you're not bleeding as much. And actually, it's the one that hasn't been attacking the lows. I'll show you some comparison here shortly. So Dow Jones, interestingly, on the first place in here, followed by small caps, you know, that have been the one that have been beaten down the most, you know, when this whole sell-offs kind of started. Then you have down transports, which is also doing fairly well here. The RSI is not able to break above 15 here, right? So you're still in a downtrend. And usually, you know, rallies into 50 RSI and downtrends are tending to get sold. So, I mean, none of these are above 50 in the RSI, none of these charts. Look at utilities, right? A big defensive sector has been taking a huge beating here over the past couple of weeks. I mean, it dropped the utility index from 1,050 to 850 in here. 30 RSI and trending lower. NASDAQ, you know, NASDAQ Composite, S&P 500. And then, you know, towards the middle here, you have some micro caps and, you know, maybe the Russell, but just a kind of a quick overlook at kind of what's going on and who's the strongest out of the U.S. Equities in here. All right, let's take a look at the Fed. So this number here has been fluctuating quite a bit lately, and it's been going between a 50 basis point hike in November meeting, right, in November 2nd, and a 75 basis points. With the latest inflation data that we've got, you know, this was a big scare for the market, and this ratio just kind of moved strongly in favor of a 75 basis point hike, and the market assigns about a 97.2 probability of that happening. So it's probably a given that they're going to raise 75 basis points unless something really bad happens between now and the end of October, right? Remember, on Monday we have the anniversary of the 1987 crash, the Black Monday, that actually happened on the 19th. On Monday it will be the 17th, so pay attention to that. You're probably going to hear a lot about it on Monday. Then there's also, you know, the market is pricing in at about a 70% chance of another 75 basis point rate increase in December, at the 14th of December meeting in here. So 275 basis points increases from 325. You're going to go to 475, you know, terminal rate towards the end of the year, and then maybe by December, I think they're trying to slow down in here, probably only with about 25 or 50 basis points. But, you know, they're still aggressive in here. They're still aggressive. It is what's going on with the yield curve. The yield curve, it's heavily inverted between the 2 years and the 10 years, right? This type of yield curve precedes recession. This could be a very heavy recession coming out. Surprisingly, still the 3-month bills in here are not above their 2-year notes. And this is something that still might hint that we might be able to escape a recession. Usually you want to see this climb higher, and that's really when the monetary conditions are starting to tighten really bad, and that's when you start to see more collapses in the market. And this 3-month, it's still not above the 2-year, right? You have a couple of inversions between the 20 and the 30, and then you're steepening between the 10 or towards the belly of the curve here between the 10 and the 20, and then between the 2 and the 10 you're pretty steep in here. And you can use this from stock charts and just kind of go back and see kind of how it looks and how it happens across time. And I mean, look what happened in 2008. You could see how, I mean, look at the 3-year right there, right before you actually made the top. Now, we've been selling off in a steepening yield curve, and we've been steep and steep and steep in the first leg of the decline. Then we slowly started to invert. So it's a totally different type of market that's happening right now. I don't think a lot of people can put their finger on it, and whatever worked before in terms of comparison, it doesn't seem to work this time around. So there's something else happening underneath the surface, something that we'll see in hindsight maybe years later down the road. But this is kind of where we are. Let's take a look at let's also take a look at yields. And I mean, just in a huge uptrend, right? You can look at the 448, 424, 426. I mean, a lot of these are about 4. The only one that's below 4, it's the 3-month. That's at about 381 right there, right? And then you have the 30-year, which is at 399. Come on, that's like, everything above the, everything on the yield curve, it's about 4%, right? Which is pretty damaging in here. And this is the FanFat futures, which is not updated yet, but that's at about, 325 at the moment. So they're probably going to update this one at the end of the month. Yields moving higher, this thing moving lower. So, markets are obviously not happy, the S&P 500 with the latest rise into these yields. But, I'll show you a chart here shortly on the counts on the 10-year. I think we're in the final stage of a 5th wave in there, so that's interesting. We'll soon get to that. All right, let's take a look at the macro weekly picture, and I'm going to go through these charts, really quickly. This is kind of what I'm watching. This is on my main macro list, and on the weekly time frames, right? You can look at the copper that's hovering above the 200-week moving average. That's providing support. You want this really to hold, but it looks like 1, 2, 1, 2, 3, 4, and 5, 4, and 5. So, this things might not look pretty towards the end of the year in terms of kind of what the copper will do, or maybe even in the first half of the next year, based on kind of what I'm seeing here in the structure. But for right now, I think we're doing some kind of a 4th wave in terms of kind of what copper looks like. If you start to break back above 380, then I'll be more encouraged that maybe things are about to look better. But for right now, they don't. The S&P 500, it's closing. I think it's closed this weekly below the 200-week moving average, which is the first close. I mean, the one in the pandemic we can maybe delete because this was a one in a lifetime event and we pushed quickly higher, but we really haven't seen closes like that in a long time. And okay, it's not a super strong close, but it's there. And we've gotten rejected from 3,800 on the weekly time frames in here. The 200 days pointing lower, the 50 days pointing lower. And, we'll take a look at the counts, but this weekly picture is not that pretty in terms of candlestick patterns. You can maybe see in here a 1, 2, 3, 4, and 5, which I'll take a look. So there's maybe a little bit of a rally coming up. Well, we'll see how long that's going to be sustained. Take a look at the NASDAQ. This one is with a heavy close below the 200-week moving average, with a big rejection last week as well in here. There is no bullish picture out of this scenario here. There is no white candles. There is no bullish engulfing. There is no no candle formation here that suggests bullishness at the moment. You're taking a look at the NASDAQ composite, which is the same thing. There's about 3,000 stocks, I think, in here, all just kind of coming down. If you look at the number of stocks below the 200-day moving average, I think there's only like maybe 10% that are above, or maybe even less than that, on the breadth statistic. Dow Jones looking a little bit better, but because it had a couple of weekly bullish weekly closes in here, if you can see, but can you really trust these? I mean, these are just kind of pathetic if you ask me, right? There's still rejections from these higher levels, probably a resistance up in there. I would like to see a weekly close back above it, right? That would encourage me, but for right now, it doesn't look that pretty. Although, you know, you do have outperformance from Dow Jones versus the rest of the markets. So that's what I like to do. I like to go at the end of the week and just kind of take a look at these charts and see, you know, what's the story in here? Who's stronger? Who's weaker? You know, what's going on with the overall trend? You know, pretty good volume in here as well, maybe a little bit more than average. You know, IWM, so the Russell 2000, you know, still kind of flat, did not make new lows, right? So along with the Dow Jones, it's one that's a little bit stronger. But I really don't trust this because you're basically below the 200 week. This is pointing lower the 200 day. And it's probably going to take quite a bit of work. Could you say this is a double bottom? I think it's very premature. We gotta see price action kind of climbing out of here. And so far, this formation in here, it's not very encouraging. Let's take a look at Bitcoin. It continues to just tread water. It tried to break below 18. Actually, it didn't break below 18K. I think it was at just at about 18K that held support. And now we're pushing back towards 19. It's a market that's still hanging pretty strong in there, right? And you see in terms of relative strength that it's kind of holding its own, but it's, you know, well below this 200-week moving average as well. And it's, you know, just not convincing enough that we can rally from here. I mean, maybe it's a 1, 2, 3 wave forward and another drop in fifth. This fifth wave could be, and there's no way of knowing how long it could be. It could be a very short, just below 17.6, and you could finish it off and rally. It could be all the way down to 10K or 13K. Right? There's no way of knowing how long a fifth wave. You can do all kind of measurements and projections and things like that, but until the market actually turns from there and starts creating a low, it's going to be very hard to secure a fifth wave. But it does look like that's what it wants to do. It wants to test the downside and create a full impulse of the 69K highs. You know, I'm not even going to go over these bonds again because they've been like going crazy, right? Here we are. You know, what can you tell on the weekly time frames? That, yeah, they're extended and maybe the RSI is through the roof and stuff like that, but it's a full bearish, you know, move in here. And look how far you are. I mean, you're maybe what I can notice is the fact that you are very stretched below the 200-week moving average, very, very stretched. And there should be some kind of a balance in here. So, you know, I think, you know, a stabilization here in yields and in bonds would be welcomed and just give a chance to these moving averages to kind of catch up and for the market to start to stabilize a little bit in here, because right now it doesn't look that pretty, right? Who knows how many bodies are going to float to the surface once the story is over, because we just heard about Bank of England, but and the pension funds in England, but you know, there's probably a lot more hurt out there and people that continue to capitulate, and who knows, right, how many funds are going to be affected, because, you know, the bond market, like I showed you before, is the biggest in the world, and it's got a lot of people, everybody's got exposure to it. So, all right, US 10-year yield in here continuing to push higher. We'll take a look at the count. The dollar, it's slowing down. It's been slowing down for the past couple of weeks. I mean, you can see 114.75, nice rejection out of that level. Then a bullish hammer of this moving average, of the 10-week moving average. And it seems like it wants to go higher. My count shows maybe one more push and then we're done. I'll take a look in a second, but I think we're losing momentum in this rise in here in the dollar. And you know, the sell-off in the dollar along with the sell-off in yields will probably help market stabilize and try to rally a little bit in here. Again, you know, we'll see for how long that will last if it does. And then gold, it's being pressured to the downside again. It's getting below the 200-week moving average. You know, they try to rally it back up, but short-term momentum traders have been selling, and it's closed at about 1648, and you know, it just doesn't look pretty. WTIC in here, so this is West Texas oil. It's you know, it's at about, what is it, 93, I think. It's where the 50-week moving average is. It tried to rally for the past couple of weeks, and it got rejected again. There might be some more strength in here. I had a short XLE position that I closed. You know, we've made some decent profits on short oil from 92 on the futures, 92.3 I think, and we sold into 85 into the pro room in here, and I kind of got out of those positions. Right now I'm just you know, trying to read it a little bit better, but it does look like a double top in here. It would continue to look lower, especially with you know, with global growth slowing in here. EFI international markets continuing to get beat down below the moving averages, so nothing good really happens in there. Also, I'm waiting to see what's going on with the dollar, and if you can notice, right, there's probably a golden pocket in here in terms of retracement. No real indication from prices yet, but combine that maybe with a sell-off. You know, if you want to try to pick a low in here, it's probably going to be tough, but you know, it's something that I'm definitely watching. Definitely want to see from the weekly time frame something that looks a little bit better, a little bit more interesting in terms of candlestick patterns. VIX is sitting very elevated. It hit at about 34.88. You know, big resistance in here. This is places where you would want to buy stocks instead of sell them, or sell volatility, obviously, instead of buying it. And that's what I say when, you know, unless VIX sells off, these markets are not going to rally, right? This is the fear gauge index. This is people showing you they're continuing to buy puts and protection, and they're very scared about what's happening. You are into resistance. Everybody's waiting for a big blow off into the volatility index to kind of mark a low in the markets, but you know, I don't think you want that. You know, who knows, you know, what Pandora box that can actually open. So that's what's going on in the VIX. All right, let's take a look, quick at the market comparisons in here. So I'm taking a look at the S&P 500, Dow Jones, NASDAQ, and then IWM, the Russell. This is the 200-day moving average. You can notice, you know, how divergences happen. I mean, you know, you can actually maybe create a new theory, a new Dow theory, a new modern Dow theory out of these charts, just to kind of see how everything moves in here. Let me just take off this crosshair. But you know, what we're looking basically in here, it's how the markets are working in sync, or if there are any discrepancies between these markets. You can see the S&P 500 is making new lows. And you can see that the Dow Jones, it's not. It's actually diverging, right? So there is a signal in here. We don't know who's right and who's wrong, but there's something definitely to pay attention, right? If this Dow Jones is not confirming the S&P 500, what does that mean, right? Let's kind of put it on the gauge. Let's pay attention to that. Does that mean that the S&P 500 is wrong and is going to come with a bigger rally? You know, you look at the NASDAQ as well, right? Much steeper than the S&P 500, and look at the Russell, which is also like the Dow Jones Industrial, just showing, you know, positive divergence in here. So, a couple of things to just pay attention, because look, back before we started the big sell-off in the markets, you know, the weakest, not the weakest, but the, you know, the smallest cap stocks and the higher beta stocks that are in the Russell 2000, those were the ones that were showing you that this market is in trouble, that a lot of this froth is coming out because there was a huge divergence here in IWM versus the NASDAQ, which was flat, versus the S&P 500 that was making new highs, versus the Dow Jones that was making, again, new highs. So obviously this divergence is very small. It's nothing like this yet, but pay attention to what's going on in the Russell. And if these stocks are starting to trend higher or make less and less new 52-week lows, that means that there's pockets of strength underneath this market, and that's kind of where you want to be positioned. So that's kind of what I'm reading into this chart in here. Let's take a look at a little bit. So I'm taking a look at the breadth indicators, and basically you see here, you know, the ratio between the total new highs in the markets and new lows, the 52-week highs and 52-week lows. The top in here, you have the New York Stock Exchange. So, you know, all the stocks that are trading on the NYSE. In the middle here, you have the S&P 500. I mean, look what happened on Thursday, 163 52-week lows. You know, and then we bounced out of there pretty heavily, and we've made, I don't even know, I think we had 7, even though we had a pretty big sell-off on Friday, we only had like 7 stocks making new 52-week lows. Don't you think that's interesting? Like, big sell-off, I think it was mostly kind of option expirations and stuff like that, because we did not get near, even though the move was pretty strong, we didn't get near the level of sell-off that we've gotten on Thursday. So it looked like a capitulation, especially with the reaction that we've had from the markets. Also notice on the S&P 500, you have a big, and this is the daily chart, you have a big outside day, right? Where you have both the open, the close, the high and the low, that's engulfing basically the previous candles. And it's a huge outside day in the S&P 500, which can, you know, mean there's might be some rallies coming out of here over the next few weeks. You look at this extreme sell-off that happened. I mean, look at the NASDAQ. And look at this guy, right? This guy started to make 52-week lows back in, October, November 2021, and it never stopped. I mean, just very little green in here, right? It's the one that's been the worst performer right there to 52-week low. So also what I'm watching is divergences in here, right? If the market continues to push lower, and then the 52-week lows become less and less prominent in here, that means that, again, the market, it's kind of finishing off, they're selling off, and there's no sellers left into that market. But for right now, you have a little bit of a divergence in here, with the exception of the S&P 500, which this sell-off kind of created a big drop. But pay attention to what happened, in similar situations where you've had major sell-offs, right? You've gotten nice bounces out of here. So this is a breadth indicator that I keep an eye every single day. Then take a look at the advanced decline line. This one, it's not looking that pretty. We had a big failure in here, right? We made a new high, the number of advanced issues versus declining issues. And that was a big trap. This is right here in the S&P 500 at about 4,300. And this picture is not that pretty, right? I don't see any divergence in here. I just see a lot of deterioration in the stocks, right? This is a cumulative line. So, and this one is pointing lower. You're breaking below the bottom of the channel. So I need to see this indicator starting to push higher and show us a little bit of strength. But this is the one that's actually worrying me a little bit. So pay attention to the advanced decline line. Again, big failure in here, and it looks like we're in an impulsive decline. We might still have a little bit more to go. So that comes, in the face of what I've showed you just a little bit earlier, and in the face of that candle on the daily that is an outside day that should show, a bullish reversal out of there. But, I don't know how much to trust that, guys. All right, take a look at the sentiment. VIX, again, just back at about 34. I'm just showing you previous instances where it kind of hit those levels, kind of what happened to the market. I forgot to put this one at the low, right? Just VIX spiking up and then a big rally, coming up into this kind of pocket of resistance. And, we gotta keep an eye on this because, just like support matters at the bottom, resistance matters at the top, and as fearful as you might feel up into these levels, right, those are the times when you can look the other way for bounces. So short of a big explosion out of here like this, the chances of it actually reversing from these levels, I'd say they're pretty high, kind of looking at what happened in previous instances. And I'll show you the one also on the NASDAQ as well. Here's the resistance on the NASDAQ. It's almost hitting 40 VIX on the NASDAQ. And again, just kind of similar situations where VIX, hit those highs, and then you've had, quite a bit of rallying after that happened in here. So, again, I think we're at some extreme levels. That's what I've been saying at the beginning of the video, right? It's a make or break moment, and a decision has to happen soon because these levels of volatility here, they cannot be sustained for too long. Either we're going to break to the upside and create a market crash, either we're going to have a big rally coming up. So one of the two things here with VIX sitting at this level. So every time you're touching that, you're not sitting there for too long. You're basically either breaking through or reversing. So that's kind of how I'm reading that. And then I'm looking also at the VIX of the VIX. So this is the volatility of the volatility, right? And it's been being pretty low. I've talked about it several videos back when VIX was kind of at around 19 to 20. But now, as the VIX is pushing higher, the volatility is trying to increase, but it's not, it's not that aggressive either. I mean, look at the spikes in here in the VIX, the volatility of the VIX, right? Huge moves, and we're still kind of at about 100. So I don't know what to make of it. Maybe that there is not a lot of, not a lot of volatility in this kind of, in this fear index. All right, let's take a look here at the last chart before we move on to the Elliott wave patterns. And this basically is also, it's another sentiment indicator. This one looks at the National Association of Active Investment Managers. This is basically showing you, how much the investment managers have allocation to the equity markets, right? And they're almost all of them are like, either out of the market or with very little allocation, and people have been selling off, moving cash to the sidelines, just trying to get protection in here. Only about 19%, almost 20% allocation to the equity markets. It's one of the lowest levels we've seen in a long time. I mean, obviously you've had a COVID low, but then if you go back, you have to go back to maybe a pocket in 2015, 2016 in here, and then back in 2014, right before you kind of started to jump. So people are very negative. You know, the RIDEX flows also, these are, you know, a bunch of funds that are in the RIDEX family. Everybody's flying to safety. I mean, look at these levels. You know, again, just that the COVID lows in here, then back in 2018 when Fed screwed up the markets as well, and then, you know, even lower back in 2016 and 2015. So again, just a huge flight to safety. Everybody's fearful. Everybody's fearful. All right, let's jump and take a look at the counts. I'm going to start with the S&P 500, then we're going to go and take a look at the ARK ETF. I'm going to take a look at GBTC, the dollar yields, and then I have a couple of other charts. I think it's just Spotify towards the end. No, Tesla. I want to show you Tesla, and then Spotify towards the end. All right, so let's take a look at the S&P. We're still uptrending in this kind of secular bull market. We're obviously cyclical correction in here. At least that's kind of what I think based on this 1-2 scenario. WXY with another failure up in X, and then we thought that this might have been a Y wave. But I think due to its impulsive nature so far back to the bottom of this channel, I think it's just wave A of a larger wave Z in here. So WXY X, and this was, we thought that this was Z, but it's instead A of Z. So ABC. Let's take a look at the daily time frames. Oh, before I go, you know, I mean, ask yourself, is this market gonna come and travel here towards the bottom of this channel? I mean, this break is pretty serious. We've had a couple of situations where we break below and we rallied, but we're approaching 33.93, and that would be a major support. But again, it's just not looking that pretty. It's just not looking that pretty. It looks like that's where he wants to go, towards the 618, maybe towards 3200. Let's take a look at the daily time frames. I've showed this on Twitter as well, I think, you know, where I'm showing this kind of beautiful equality between the decline of the waves. So you can look at this, you know, this Y wave, right? And then look at this wave A as well. I mean, the angle of a descent is pretty much the same. It's pretty much the same move. Even the counts are very, very similar. Then you look at the rallies, B wave of wave W, B wave of wave Y, very similar in magnitude, very similar in shape, direction. Then this corrective X wave are also very similar. This one was a little bit bigger, but the same formation, ABC, ABC. So markets work through this kind of gorgeous patterns. You just kind of have to look down and find them. And, you know, here we are kind of declining again in this kind of 1, 2, 3, 4, and 5. And I'm thinking that, you know, pretty soon we should get a rally higher in probably in another B wave, right? So it's either going to be a B wave or, you know, a wave 1 followed by a 2. But by the way these markets are looking, you know, I'm probably going to stay with the B wave idea until I see, you know, more things developing, because you can have an alternate. You know, some of you might ask me like, hey, Chris, you know, what if this is an A, right? 1, 2, 3, 4, and 5 for the wave A, that's a B and that's a C, and you know, that's fine. It's you know, nobody really knows how it's going to end up being in terms of proportion. It doesn't look that clean. I mean, if I go, you know, let's say that's kind of what you're looking at. Let me see, maybe I have it here. Yeah. So I mean, look at this. Right, 1, 2, 3, 4, and 5, and you're doing some kind of a leading diagonal out of here, even though the third wave is a little bit bigger than wave 1, so we have a couple of issues with that, right? Then you go in an ABC for a B, and then you're going in a 1, 2, 3, 4, and 5 for the C wave, right? And that would mean that, okay, this market is over, this correction is over, and you're actually going to new all-time highs. By the way things are looking, everything I've showed you so far, right, things are not looking that pretty, right? So lows might take a little bit of time to form. And I'm not sure if this is where we are. But if the market shows me, you know, a pretty good impulse out of here in a wave 1 and a wave 2, you know, and we're starting to climb back above this B wave, above 4,300, then I'll be, you know, more willing to entertain that idea. But until then, this is kind of sitting towards the back of the burner, toward the back of the stove there, right? Just kind of simmering in the background. The main count that I have, it's this guy right here. This is kind of what I'm going to be watching. And then the other one that I have, it's this kind of very ugly count, right? This shows a completed fifth wave at the cycle degree. You go back to the primary degree as well, and then you know, all hell is breaking loose next. It's a 1, 2, 1, 2, 3, 4, and 5, 4 and 5, and then, you're coming back towards 2200 in, in the S&P 500. I mean, remember, a lot of stocks, especially from the high beta stocks, are already near these lows, right? Like, I'll show you ARKK. That's right there at those lows. Who knows? I mean, there's a lot more stronger stocks in here than just in the Russell. But, is this possible? Of course it is. Of course it is. Anything is possible. Probable, I mean, by the way things look, I'm there. Like, it's very possible. It's very probable too, right? The only thing that I'm waiting for, and I think the bigger decision that will be made will be if, what's going on after this rally that's supposed to come. All right, and that's kind of what I'm waiting for. Let's see if we're going to get a second wave, a little bit smaller than this, and see how that looks. Because if that looks parallel and in a corrective manner and stuff like that, then we got to get ready for a big sell-off in there. But if it looks impulsive and you're starting to climb and climb and climb and get toward 4,400, 4,300 in the S&P, then obviously that probability gets greatly diminished. So, that's the bearish kind of count under this fifth wave scenario, that you're going to go in a 1, 2, 1, 2. So I think either way, right, there's probably a rally around the corner. We just don't know how that's going to pan out, right? So that's kind of what I'm watching, and then kind of looking at the smaller time frames. If you guys want to see the count in here, right, you have a pretty nice 5-wave decline in here in a wave 1, I would argue. Then you have a second wave pullback into 41.20. Somewhere into the 61.8 zone. Then you drop again, 1, 2, 3, 4, 5 in a wave 3. You go up in 4 and you drop down in 5. Once you finish the fifth wave, you create a nice big, daily candle in here, right? That outside day formation. You're maybe selling off in a wave 2 right now. And then you're starting to do, let's say, wave A of B. And this is how that would look, right? You're going to go maybe in something like this, A, B, and then up in C for this B wave. That's kind of what I'm watching, and this becomes either a B wave or a wave 2, and then you're declining lower. If this thing starts to rally much higher, right, and it starts to get a little bit better, and this wave extends, then it's probably not going to be a B wave, but rather maybe a 1, 2, 3. So we'll continue to watch for that. Now the big question is, what happens if you're making new lows already? Well, that means that this wave A is not done. There's probably a series of 1s and 2s in here, and the market is really bearish. But I'm probably going to back to differ on that coming up here into the next week and into the Fed announcement. So that's what's going on in the S&P 500. ARKK, guys, and this is not a log scale, it's just an arithmetic scale, but back to what it started below the COVID lows in here, right? You're basically back at about $33, $34. I had this count, as an ABC formation. I'm starting to doubt it quite a lot now, because this move here looks so impulsive, right out of here, this whole thing, and it's pretty clean, I would say, third wave followed by a fourth and a deep fifth, then another fourth wave in here, in an AB ending diagonal in a C, followed by the next decline lower. The good news is that you're probably, again, I think I've talked about this before, you're probably in final stages of this decline, right? So, it's very tough to get bearish. You don't have to get bullish in here, right? Because you don't know exactly how this fifth wave, it's something to definitely watch. But getting bearish at these levels, I think it's a tough game, right? Actually, we haven't reached 33 yet. The lows from March of 2020. And also I have a problem maybe with this wave 1, because you have a 1, 2, so a very small wave 2, a big triangle in a wave 4 with a wave 1, but counting it as a correction just screws up this whole decline. So I think I have to go with the wave 1, 1, small, 2, 3, 4, and 5 for 1, 1, 2, 1, 2. So that creates a larger third of a third. 1, 2, 3, 4, 5 for 3, up in 4, down in 5. Another 4 in here compared with the second. And then you're doing a 1, 2, 1, 2, 1, 2, 3, 4, and 5, 4, and 5. So there might be a couple of more subdivisions still in this market, unless you're doing some kind of an ending diagonal, which doesn't look like at the moment. But, I'm probably willing to bet that there's not a lot left in this move. right? And after this becomes an ABC, right? Or you're beginning a next cycle, whatever. And you're probably going to climb back towards 53, maybe back towards 72, but this might be, you know, months and months down the road. So don't jump into this thing just because it says that it's the end of the fifth wave, unless you have a huge time horizon. You know, they might be able to get this thing even cheaper than what it is. But 33, we'll see what happens next week. It's an interesting level for sure in the ARK ETF. GBTC, a little bit different setup that you have in Bitcoin. And I'm looking at this whole climb as a 1, 2, 3, 4, and 5 with a truncated 15 here in a 1, 2, 3, small 4 up and 5, just kind of counting this decline from these levels rather than from these levels, and going through a 1, 2, 3, 4, 5 impulse in a wave 1, then up in an A, B, up in C for a wave 2, then you begin the next decline lower, and you can see it in here 1, 2, 3, 4, and 5 for a wave 3, so big wave 3 decline, up in 4 again, a little bit smaller than wave second, and maybe in the final stages of this fifth wave, you know, 1, 2, maybe 3, 4, and 5. If this continues to push lower, that means that probably Bitcoin will try to crack in that fifth wave as well. And at some point this will finish off, and then we will get, and I'm also kind of, you know, showing you connecting the lows in here and then projected it from the high. And in case of a rally, we'll see where that's going to go. But this market is not that bullish, right? It might turn bullish. You have a little bit of divergence here in the RSI, you know, which is kind of, you know, particular for the fifth wave decline compared with the low in the 3, which is kind of what you want to see. So, you know, let me say that I'm, you know, for using, you know, a term that's out there, right, just kind of cautiously optimistic on this, you know, but I need to see a little bit more from this market. I don't think that this pattern is fully done. You would have to look at it as a 1, 2, 3, 4, and 5. So almost like, you know, almost like some kind of a ending diagonal in here, something like that. You know, if you really want to kind of force a look into a fifth wave decline, but you know, let's get back above 14 first, at least back above those levels, right, before we kind of get a little bit more bullish. Until then, I think there's probably a little more trouble ahead in here. So that's what's going on with GBTC. I just wanted to kind of show you that and kind of where we are overall. I mean, there's some big support up into these levels, so we'll see what Bitcoin will do next week. But that's my count on GBTC. Then UUP, I'll show you the count in here. Again, just kind of starting the count from these lows. I think this was a fourth wave of this entire decline with the final drop. And then you're going in a 1, 2. Then you have another 1, 2, right? And then you got 1, 2 again. I'm sorry, 1, 2, 3, 4, and 5 for the third. Down in 4, up in 5 for the wave 3. Down in 4, and then in the later stages of this fifth wave, right? I think, I mean, I'm starting to lose the RSI in here. You know, this seems like it's struggling. It doesn't look like anything we've had before in terms of where these declines were. So, you know, my thing in here could be that this is still maybe, you know, a fourth wave. So you go in a 1, 2, 3, 4, and 5. So maybe there's a fourth wave triangle forming right now, and then with the final push in the fifth wave, the divergence will get even bigger, and then you're rolling over. So that's why I'm not, I mean, listen, you've had magazine covers boasting about the dollar strength, everybody's bullish, the dollar, whatever. You know, I talked about it, I think, last week as well, or a couple of weeks ago. You know, you saw those magazine covers, and you know, there's no end in sight. I think it was something that one of those magazines were saying, I think Bloomberg Weekly. And you know, to me, if you're attacking the top of this trend line and you're in a big impulsive move, and the subdivisions here look fairly straightforward, I mean, sure, you can continue to explode, but I don't think it's sustainable. I think we're probably going to get a pause and a little bit of a pullback. It's coming here down in a few weeks. So that's kind of where we are in the UUP. And then take a look at the TNX as well. A couple of counts I showed you last week in an ABC, but I want to show you a different one. We're back into huge resistance levels as well. But let's just assume that this is still an impulsive move, and we're not getting, let's say, a return to yields back to 140, but rather maybe something smaller, and that would look like this. 1, 2, Notice this is not the log scale, it's the arithmetic scale. In here you can see a little bit better that actually this move in here was actually part of the decline. 1, 2, 3, 4, and 5 in here with the fifth wave, with the truncated fifth, because this was a flush down to 40 basis points in the 10-year yield. So from here, if you count an impulse, you go up in 1, down in 2. So you have 1, 2, 1, 2, 1, 2 again, third of a third of a third right here. So 1, 2, 1, 2, 1, 2, 3, 4, 5 for a third, down in 4, up in 5. Okay, now we're finding resistance here into that kind of 4% mark. We're starting to slow down a little bit in here, just a little, but the calls are coming in that the Fed is hiking too fast, that things are getting crazy, that they're going to break the bond market and all that. We might be falling into a fourth wave in here. Okay, and that's kind of what I'm, either a triangle, maybe a flat, who knows what's going to end up being, but, and I don't think it's going to come that deep as this is, right, because that would be a big crash in yields, but at least get back to 340, 350 and stabilize the markets, and you know, then maybe next year we're going to get one more push higher, because then by that time the market's going to get used with this kind of higher yields. Possibly, you know, I'm not that big of a macro thinker to know exactly what everybody's going to do on their kind of borrowing and lending and all of that. But the chart structure shows that there should be another pause coming in here in the yields, and it's likely going to be a fourth wave. If not, something a little bit bigger. If this is the end of the C wave, then you're probably going to do another ABC down or something like that. So this is kind of the look in yields, and I'm going to close off with a look at Spotify, which is a chart I wanted to do a separate video on. And I decided not to. I said I'll include it into this one. I think I show it to the members on Friday as well, into our stock channel. But this is, you know, a beautiful 5-wave decline. I mean, almost a textbook in here. And you can see just the 1, 2, 3, 4, and 5. There's a leading diagonal in here. It's not expanding. I think it's the contracting variety, because wave 3 is smaller than 1, wave 5 is smaller than 3. The only issue is that this fourth wave is a little bit bigger than 2. They're supposed to be a little bit smaller. So, but that's the kind of diagonal impulse lower in a wave 1. Then you go up in a clean ABC in a wave 2 into the 618. Then you sell lower in a 1, 2. Then you begin with the 1, 2, 3, 4, and 5 for this larger third wave decline. That's the meat of the move. You get another fourth higher. Then the final fifth, you can see it in here, 1, 2, 3, 4, and 5 into this wave 3 bottom. And then you rally again in 3 waves, right? Just like you do in the second wave. And this has got to be a fifth wave, right? And just like in the ARKK, just be patient in here, wait for it to kind of finish off, maybe create a little bit of an impulse. There's time, you know, these bottom formations take a little bit of time to form. And but it does look like, even on the internal structure, if you go back, let's say, to maybe a 6-hour chart, something like that, you could start to see, you know, in a wave 1, 2, 3, 4, and 5, maybe a couple of more subdivisions in here if I'm totally wrong. But I think we're running towards the end of this. Let's see how the RSI is between 3 and 5, right? And it's not a huge divergence. Actually, you can see it a little bit better here on a 2-day chart. Right. So Spotify, it's towards the end of its declining structure. Right. But again, just be careful. And, you know, dollar cost averaging, you know, again, this is not financial advice. It's just education. But, you know, usually what I would do in situations like this, if you're eager and you don't want to wait, right? Just like, okay, let me get a few shares now. I'm going to get a few shares later. And then, you know, it's just something that you can obviously manage. But if you want to wait for an impulse, right, that's even better. I don't know how it looks in terms of kind of where the moving averages are, but, you know, I mean, I listen to Spotify every day. I don't know how many listeners they have. I don't know how much money they make. I didn't look into the financials. Maybe everybody's talking bad about it. Maybe they're going bankrupt. Who knows, right? I don't know any of that. I'm just watching the structure, and the structure tells me that watch out, you know, unless you're going to zero, right? There's a decent chance that this is a fifth wave, and you're probably going to end up moving higher at some point in the future here. All right, guys. So listen, I'll leave it at that. I mean, this was you know, I don't know how long this video is, but I appreciate you as always. Don't forget to leave me a like, you know, subscribe, obviously, visit me in the program, visit me on Twitter, come hang out, and I'll see you next week. All right. Bye-bye.